Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Jamie Constable of R Capital to talk about the Flight & Partners Recovery Fund. Tell me about R Capital.
Sure, R Capital. Well, I think to give you the background on R Capital, I probably need to go back to my very young, tender age when I was 22, 23 at Touche Ross, which was in 88, 89. And that's when I first got into restructuring, really. I left Touche as soon as I qualified, and one of the partners contacted me and asked me if I could come and help him. And he was doing turnarounds, and I had to turn up with a laptop and was on a day rate, but it was a fascinating period, 89, 90, 91, 92. That was my first recession, and I then really just acted as a consultant. I worked with this guy for a year, I then went on my own and just got heavily involved in restructuring businesses. It was a fascinating recession. It was a recession where there wasn't really any help from the government, and businesses were going bust very, very, very rapidly. And I learned a huge amount, and I also saw how much money people made from buying distressed businesses. I was doing very well as a consultant, but I didn't have the capital to buy. But I did put lots of deals together where people could buy, and I just saw how much they made. And one thing that I realized that I wanted to make sure I was there with the capital next time that this happened. So as I set up various different businesses. I've always been quite entrepreneurial. And then in 2001, I thought, right, okay, this market's coming back. 9/11, there's going to be a recession. So I got active again. And it was a funny period because it didn't really cause a recession. There was a lot of dot-com businesses that went bust, but they're not really businesses you could turn around. But I did realize that in any market, there's distressed companies, and there was enough to invest in. So we got quite busy. And then in 2004, I managed to persuade a lovely gentleman at Lloyds Bank to sell me the bank debt. And banks historically had never really sold debt. That's not something they ever did. And an opportunity came up, and I offered him par for the debt because I wanted to show them what we could do to work with the bank to take over the debt and restructure the business. And it went very well. And on the back of that, we realized we probably needed to create a brand name. We didn't really have a brand before then. And I had a partner with me who was an ex-banker from NatWest, and we creatively came up with the name R Capital because it was our money, and it was no more complicated than that. And that was 2004, and I guess that's where our history as R Capital starts from. And then, we've since then we've probably done 75, probably about 77 deals now. We currently have 15 in our portfolio, and we're just very focused on what I call the smaller mid-market turnarounds. This is businesses from 5 million to 200 million of turnover that have got themselves into trouble. And we're very, very selective about what we do and what we buy. We probably only get involved with 5 to 6 deals a year. We always take a majority control of those companies. And we look at over 600-700 opportunities a year. So we're incredibly selective, but we got over the years, what good looks like, and the ones that you like. And we're very, very hands-on. We go in and we really get involved in these companies and turn them around and look to sell them on for obviously a much bigger price than we pay.
And what is the Flight & Recovery Fund?
So in 2007, I was approached by Howard Flight, who's now Lord Flight. He used to run something called Guinness Flight, and he was very keen on setting up a fund. We'd always shied away from having a fund. We didn't think it suited what we did. You don't need a big pile of money to do what we do, but you need a lot of expertise to do it and a lot of good people to do it. He was very persistent, and he had a group of individuals, mainly friends and colleagues that have followed him, and he was really keen on setting up a distressed fund. So we agreed with Howard that we would support that by using that fund and being an advisor to his fund. And that started in 2008. It was a relatively small amount of money he raised. I think it was £10-11. And I put some money in as well to show commitment. And we used that for our smaller deals. And we've used that ever since. Each
That's
year,
10 or 11 million.
Yes, that's right. But the smaller deals would be like up to £1.5 million per deal we would use into the flight fund. After the 7-year period, we just assumed it would close, but they were quite keen on it carrying on. And some more investors came in at that point. And we got to a point now where our capital we're very successfully invested. It's predominantly been my own money outside of the flight fund. But I've now got a good team. My original partner retired in 2016. He was a bit older than me, and he felt it was time to retire. We've got now a younger, quite a dynamic team, and one thing I was keen to do is create longevity in our brand. And I'm very conscious that I'm funding virtually everything outside of the small ones that Flight do. So we've decided that actually we'll put more of our deals into the Flight and Partners Recovery Fund. So that's the reason we've decided to raise some money, more money for that fund.
And how much are you looking to raise?
Well, we'd like to probably get to 50, but we'd like to stop at 25 and take a breath. Because the way the Flight Fund structured is, the last thing I want is cash drag on that fund. So, I can see that we should be able to spend 25 over the next 12 to 18 months. If it gets really busy and we spend more than that, we'll go back and ask for more. But I don't want to ask for more on day one and then not be able to spend it. And that's never a position I wanted to be in, where you've got money you have to spend, because I'm convinced that sort of makes you make the wrong decisions. If you've got money there you think you have to spend. So we prefer to have a first close, which we're aiming for at the end of the year at 25, and then relook at it next year to see if there's a requirement for more.
And where will most of that money come from?
It's predominantly high net worth individuals. We were really keen on, and it being a sort of more a clubby feel, where the type of investors will be people that have their own businesses or have invested in lots of businesses, because they will have issues that go wrong and they need some help from a distress point of view. But also, the way our business works is we're totally agnostic in what we buy. And we'll go into a sector that we don't know that well, and we need to find out as much as we possibly can about that sector in a very short period of time. So the more people we have that are invested in business, the more chance there is that we'll have an investor that's come from that sector and understands that sector, which is a real advantage to us. So it was building a group of individuals that invest, knowledgeable individuals, have been in business, that are keen to get in the space, because it's very hard to invest in the distress space. Unless you are an institution, you want to go into one of the very large funds, the only other way really is to go direct. And it's much harder than most people think. Most people think, well, I can buy it cheaply and sell it, but there's a lot more to it than that.
And then what sort of structure is it for investors? What sort of returns are you aiming to give them, and how are those returns paid? So
we'd set the structure up so that there's a real ability to cover the downside risk. So the way, let's explain how the structure works. The fund sits in Guernsey. We draw down on that fund to invest in businesses that we're buying. When we buy a business, the focus to us on day one is our downside risk protection. So when we put our money into a business, that money is always secured against the assets of that business. Because we have to move so quickly when we buy a business, we sometimes have to buy businesses within a couple of weeks, because they've got to pay the wages, or there's a big working capital issue that's going to take the company down. We don't get the luxury of doing the full due diligence, but we have a period of time where we can really understand really what the asset base is. And what we focus on is, if this isn't what we thought, can we get our money back? So we're very comfortable that it's unlikely that we will ever lose that initial money. But to make sure that that is the case, what our capital offers to the fund is that we say, look, there's equity upside that we'll create. On day one, there's no equity upside in this. We'll pay 10% on the money we draw from the fund, and any equity upside that we create, we'll give 30% of that to the fund. We benefit from the rest of the equity upside, but to ensure that there's never a loss on the capital, if there is a loss, it can come out of our equity upside. So you're underpinning the capital that goes in for all of the investments that are there. So we expect, so far the Flight Fund with the smaller deals has made an annual return of about 12%. With the ability to do larger deals, we'd be disappointed if we didn't hit at least 15%, and we intend to pay a dividend of 5% a year on those funds.
So for investors, hopefully they'll get some dividend, and then at the end they'll get capital.
They get a capital lump as well, which is obviously slightly more tax advantageous.
Okay. So you talk about distress. Can you just define what you mean by distress?
What is distress? I mean, it's a big market. Distress to us is mid-market and SME businesses that have got themselves into trouble. Now, it might be a market event, as we have today with COVID. It might be an internal event. It might be a shareholder dispute. It might be they've created a new product that just hasn't worked. I mean, lots of the businesses we look at, once upon a time, were a great business. And often what happens with a great business, they go off and they set up lots of other great businesses. But sometimes the other businesses don't work so well. And they come across our desk where we're looking at quite a complex structure of lots of businesses. But if you strip it all away, the original business is still a good business. But they've run out of money because they've spent so much on everything else. Now, that, to us, what we're interested in is that let's take it back to what it was originally. So you're now doing 80 million of turnover. Why don't we take it back to 20 million of turnover and make £4 million as opposed to 80 million where we're not making any money? So that is a classic sort of how it ends up being distressed. But that's our definition of distressed. What we're looking for are good businesses that do not need to grow their turnover to turn them around, because that's not something we like doing. We like to be in control of everything that's going on, and turnover we're never in control of. But if it's a good business that just is got a too complex structure, we need to make it simple again. We need to take it back to basics. We need to reduce the turnover. We need to reduce the overhead. Then that's what we quite like doing. But distress basically means it's gonna go bust if someone doesn't come in and do something about it.
And now one would presume is an amazing time to invest. Is that true?
Yes. There's a problem in the market which we can't fix. It's there. So it's creating a huge amount of opportunity, but you've got to be careful because lots of that opportunity brings risk. The example is, earlier in the year, we've got off of virtually every restaurant chain that was in trouble. Retailers are in trouble, consumer-facing businesses. But we have a simple investment strategy. We need to understand how much money we've got to put on day one and how much money we've got to put in to turn the business around. Because we can't work that out. We can't see if it's worth doing because we can work out how much we're going to sell it for, but we need to know how much we're going to put in. So if I get off at a restaurant chain where I can say, well, okay, I can buy that for £2 million today, that's great. But I don't know how much working capital I have to put into that business because I don't know when this situation will resolve itself. So it's too early at the moment to get involved in those types of businesses. There will come a time when, yes, now you think is the right time, we're comfortable, we can see that things have stabilised and it is time to buy those businesses. You've also got the situation that in most recessions, and as I say, this is my third recession, that the opportunity for us is as we come out of recession, and in most recessions, more companies will go bust coming out of a recession than going into a recession. It's much easier nowadays, especially with the government help, to trade through a recession because nowadays you can stop paying your PAY and your VAT, you can furlough your staff, you can get a loan from the government, so you can get through. But all you've really done is piled a load of debt on your balance sheet. So as life gets back to normal and you start to see some orders coming through, you've got no working capital. And there's no one going to lend you any money because you've got this balance sheet that's full of debt already. And that's the time when we get really busy because we can resolve the working capital issue, we can restructure the businesses. Most of them will have to go through some form of insolvency to restructure their balance sheets. But that's our skill set and that's what we do. And then we're much more comfortable because we can see exactly how much money we've got to pay for it and how much money has to go in before we can turn the business around. So there will come a time where we get incredibly busy. We have been busy this year. There's been a lot on, but it will get busier.
So talk to me about some recent investments you've made.
We bought a company called Feather and Black earlier this year. We bought that before COVID struck. Our intention was always to turn it into an online operation with just one showroom. We benefited from COVID insofar as that turning it around happened much quicker. The online was busier than we expected, and we were able to shut the shops. We actually shut all of the shops, and we didn't leave one of them open like we intended to. And we subsequently sold that business on. So it was a very quick in and out. Because it was a strong brand, it now had an online offering. It didn't have the baggage of all of the leases and everything else it used to have, and we sold it on a couple of months ago. Another company we had we bought recently was Trios, facilities management business. We bought that from a large French group. That was a turnaround that we did whilst in lockdown. We went into lockdown 2 days after we bought the business. It was unusual in the fact it's the first time we've ever turned a business around where we haven't been able to visit, we haven't been able to meet face to face the people that run the business. Everything was done on Zoom. It was bizarre in some ways because it was easier to turn around than normal because you didn't have the distraction of the day-to-day business because that became so quiet. When we go into these businesses to turn them around, we have a 100-day plan which covers so much, and there's so much energy that goes into that first 100 days. And we could just turn the business around and sort all the issues out much quicker than we normally could, even though we couldn't actually attend the premises. But I think we've all found that while Zoom isn't particularly nice to deal with, it's incredibly efficient to deal with. And we just got so much done so quickly that we turned that business around within just over 3 months and sorted it out from a loss-making business to a profitable business.
So what's the sort of typical process you go from beginning to end?
So a typical process, so as I say, we get 80 to 100 opportunities to look at a month. We're very selective about that. We're looking for a good business that's got itself into trouble. A definition of a good business is it does something that its customers, its clients really like, because I can't change that. That's key. We're also not looking for a business that's suggesting it has to double its turnover to turn itself around. We like businesses that we can see, actually, you're good at what you do. There's a reason for you being there. Your customers like what you do, so that ticks the box. Let's understand more about the sector you're in. So then we'll get involved in that business. We'll talk to the management. We'll talk to the advisors that might be offering the business for sale. We'll get into deep due diligence. We meet with the management team. We understand as much as we can about that business. And depending on our timeline, depending on how much due diligence that we do, and the amount of due diligence you do normally depends on how much you can pay for it. So if I've got a week to do my due diligence, then my offer is going to be a lot less because I've only found out so much about that business. And I probably just focused on one of the assets of the business because I don't know enough, but I like what it does. So we go into deep due diligence. We have a very intense period. We do everything in-house, save for some lawyers that we use externally. And we get to a point where we make an investment decision. Do we want to buy that business or not? Once we buy that business, we've got a very thorough process. We've already created a 100-day plan. We understand all the issues the business had. There's a good chance that there's some form of insolvency process is involved in that to reduce the debt or some of the issues that business had, whether it be a CVA. It may have been in a moratorium, which we've seen slightly more of nowadays, at administration, but some form of insolvency process often takes place. We then have our operating partners involved in the business. We'll always have a chair. We'll always have a financial guy. We have an internal CTO that we drop in. We have an internal HR girl that we drop in. And we swamp the business. And we go through a 100-day plan with a huge amount of speed to sort the problems out in that business, to get it to the point we need that business to be profitable. Once we got through that process, we're also learning about the industry in that process. And one of the key issues for us in that process is we understand what all the competitors are doing. What does the landscape look like? Who are the people that they're selling to? Who are they buying from? We want to know as much as we can about that business, because we're also trying to understand in that process, right, what are we going to do with this business now we've sorted it out? Is this a great strategic hold and we can do a buy and build here? Or actually, we've turned it around now, there's not much else we can do. It's worth as much today, it'll be worth in 3 years' time. Let's sell it quickly. Sometimes maybe it had a big pension issue. We've resolved the pension issue. So all the people that wanted to buy it before couldn't, but now they can because we've resolved that issue. So we're learning as we go of the exit and where we're going to sell this business to. And we might be learning that this isn't what we thought, and actually we don't want to be involved in this business. We want a really quick exit, and we'd just be happy to get our money back because it's not what we thought. Fortunately, that doesn't happen too often, but that's our downside risk that we're always trying to protect. But that's the process we go through. And then as we've got to that point where we've decided what to do, we then put that plan in action, which might be we're going to keep it for another 3 years, we're going to do a buy and build, etc. And then at the right time, we'll sell that business.
What is because you've mentioned some really speedy turnaround times. What's the typical turnaround time? How often?
So our average hold is about 2.5 years for a business, but they normally turn around a lot quicker than that. You go in with your eyes open. Sometimes you get in there and you realise this is better than we thought. Sometimes you realise this is nowhere near as good as we thought. The ones that are better than you thought, you're going to sort them out very quickly. But others are just going to take longer, and your 100-day plan turns into a 300-day plan. But you don't really know until you've got in there, got under the bonnet of it.
So what's your biggest success to date?
We did a buy and build, a company we bought in the last recession in March 2009, I think it was. That was a business it was the owner went bust. It was London and Scottish Bank. It was a division of that we bought from the administrators in 2009. It was a business in the home collect credit arena.
What's it called?
Morses Club. We bought the business. We could see that we had our investment covered. There was a loan book out there that was very collectible. So we bought the business in relatively short order. we started to understand it and understand the sector it was in, and realised that the whole sector had a lot of issues because the banks had stopped lending to the sector. We didn't have any bank borrowing, so we were fine, but it enabled us to buy up lots of the competitors because they didn't have any funding. So we gradually grew the size of that, and there was one very large transaction we were keen on doing. It was a business that had been in administration. It was part of Cattle's group called ShopperCheck. And that came to us in, I think it was 15, it was sometime in 15. We managed to buy that. The business went from being £2 million, we bought it, up to £15 million when we then floated it on the stock exchange in 2016.
And what about failures?
So they do come, unfortunately. It's good to say that less than 10% of what we do actually end in failure. There's two types of failures to us. A failure is something where we get our money back in an interest return, but we don't make any money on the equity. We get those, but what we get less of, fortunately, is where we actually lose capital. It does happen. It normally happens where there's a fraud or something's happened that we haven't been able to identify, especially in our due diligence process. You're relying on a debtor book that looks normal. You're relying on stock that looks normal. When you get in there and realise someone's been fraudulent and it's not quite what you thought, or we've owned businesses and a fraud's gone on whilst we've owned the business that we haven't picked up. By the time we have picked it up, it's been too late. But fortunately, that's only ever happened to us twice. So, but it's something that's very difficult to cover.
So how risky is it, would you say, what you do?
Well, I think it is a risky sector, but it's like anything in life. If you understand it well enough, you cover those risks, and that's what we're very focused on. So when we started, we didn't have a lot of money, so making sure we didn't lose any money was in our DNA. Our downside risk protection is key. So that's the way we've always looked at deals. You're never quite sure what you're going to buy. You have a limited period to work it out. So the key is to make sure that if something isn't what you thought, you can get your money back, so you're not losing on the deal. And that's really what we put into this fund, to say that we can give you nice returns, but we can also do it by limiting your downside risk, because the way we structure these deals will ensure that doesn't happen. But if that did happen, then we're very comfortable that we can offer from our equity return a cover for that, because you've got to believe in yourself. And I think that's the key here. So I wouldn't want people investing in this that, where we were making money and they weren't making money. That doesn't work for anyone. So we need to make sure they're covered. So the whole basis of this fund is that it's actually very hard for you to lose the money. The 10% return should be very easy to obtain. I'm hoping the return will be much bigger, because the returns we make on the equity that we make in the subsequent deals will fill up that pot quite substantially.
Although, of course, there's no guarantees. But
there's never a guarantee.
Never guarantees. But so in our capital, it's yourself and who else is in the team, and what do all these people do?
So in our team, my two partners are Chris Campbell and Phil Emerson. Chris is very much front end. So Chris has the relationships with all the introducers that we have. And in Chris's team, there's Josie, Lewis and Alistair, and they're shifting through the opportunities that come to us. We're very fortunate because we've been in the market for a long, long time. We get inundated with opportunities. We see most things that are out there, and that's great. We're not doing more deals. We're just being fussier about what we do. So that's Chris's side of it, and then Chris and his team will run the deal if they like it. They create the investment paper. They then bring in the operator. So we're carrying out the due diligence as we're looking at the deal, and we bring in our financial guys to carry out the due diligence as well. And also our CTO would get involved at that point, and HR would get involved, and we're starting to create the 100-day plan. Once we've bought the business and it's been restructured, it then gets handed over to Phil Emerson, that runs a portfolio for our capital. So, under Phil Emerson's control is about 15 different companies at any one time, sometimes a bit more, sometimes a bit less. And he works very closely with the operators that run those businesses for us. And we work, and then working on what's the plan for this business. We've got through the 100 days, right? Where are we going with this business? And if it's a buy and build, as they often are, right? How many companies are we going to buy? Which companies are we going to buy? Where are we going to buy them? And analysing that situation. And then we've got a support staff in the office of about 6, covering compliance, covering financials, supporting the guys. And it's a relatively tight team.
So Jamie, for someone who's interested in this area, why should they invest with you?
The key is, do you want to be involved in distressed? If you want to be involved in distress, where do you go? And there's not that many places to go, which is why so many people that I know and contacts and friends of mine have always said, how do we invest with you? How do we invest with you? You go to one of the big funds, whether your institutions can invest directly in Endless, Aurelius, I think is a listed fund, some of the Sun Capital, there's some really big funds that do this, but they do the larger deals. If you want to invest in SMEs in the UK, there's nowhere to go. You've got to go direct, which is fraught with issues. Actually buying a business on your own and using your own cash to do that is a pretty full-time job. So if you want to be in distress, I think what we offer is an opportunity to get into that market. And obviously when we started on this route and thinking we would do this, we weren't thinking that we were going to hit a recession quite as quickly as we are. I think the general feeling is, certainly our in-house view, is that this is going to be quite a long recession. It's going to take a long time to come out of this. And we're being very selective and very careful about what we buy. But you do pick up some real gems in a recession. So if you want to have exposure to that market, I think we're one of the few places you could probably go to get that.
Jamie Constable of R Capital, thank you very much.
Thank you.